Okay, let's officially start. So greetings, everyone. Hope you are all enjoying the nice springtime, nice weather today. We are so pleased to have your participation. So thank you so much for joining this event brought to you by Asian American Chamber and co-hosted by Mount J, DC, and the Philippine American Chamber, Washington, DC. Our special thanks to the event planning team headed by Ms. Laura Belden, also Zhong Wei, Tao, Stephanie Shea, and Zhang Lin. Special kudos to Ms. Laura Belden. She's serving as the co-chair for Summit Expo and also vice chair for the chamber board. And she is with the Bank of America. She's the senior vice president and private client advisor. So I would like to just take this opportunity to quickly uh, recognize our board leadership here, also our wonderful sponsors. And we encourage everyone to join the chamber if you are not a member yet. There are lots of benefits and lots of business opportunities here. So this one already just shared. You can find all the upcoming events and programs on our chamber website. Now, actually, let's welcome the head from different co-hosting organizations to see some greeting words. So Mrs. Stephanie Shea, she's serving as the board chair of Asian American Chamber, also vice president of the M&T Bank. Let's welcome Stephanie to give some greeting words. Stephanie, please.
Good afternoon, everyone. Thanks for Cindy's warm introduction. Asian American Chamber of Commerce hosted more than 50 webinars in 2020. We're continuously work additional features and for future online events in 2021 to our community. I want to thank AACC's board member, Dr. Zhongwei Tao, to sponsor this great event. And also thank our co-host, Monty J Science and Technologies Association DC chapter, and Philippine American of Commerce in Greater Washington, DC, support and participation. And Cindy showed earlier, we have our signature event. So please join AA's awards gala to shine AAPI in May. Thank you all. Cindy, back to you.
Yeah, thank you. Thank you, Stephanie, for your phenomenal leadership in driving the chamber's event and program. Okay, next, let's welcome Terry Shaw, our friend at Mount J, Greater Washington, DC. Terry is the current president, and we really enjoy our collaboration and partnership. And we're so pleased to have your organization collaborating with us today. So Terry, would you please say some words?
Yes, thank you, Cindy and Stephanie, for all your leadership, creating tremendous value to our community. Very quickly, Monty J, we're a global organization with 16 chapters, including 7 of them in the United States. Here we represent the interests of Asian American business leaders, entrepreneurs. We have some programs with the content, and our annual events generally centered around Chinese New Year, although we didn't have one, obviously, the last couple of years now due to the pandemic. Our last speakers were Chris Liu and Andrew Yan, and we continue to support the entrepreneurship community as well in the Washington D.C. area. So thank you. We're pleased to be part of the event and part of the collaborations among the organizations.
Thank you, Terry. And next, let's welcome Christina Season, a powerful leader here in this Philippine American community. Christina is the current president of the Philippine American Chamber of Commerce, Metro Washington, D.C. And under her leadership, I think she really transformed the organization. Amazing growth we cannot witness. And glad to have you here today, Christina.
Oh,
Please, your
yes, yes. Thank you so much, Cindy and Stephanie, for inviting the Philippine American Chamber of Commerce, Metro Washington, D.C. For those people who don't know about us, I became president late 2018 and tried to really elevate the Philippine American community towards business entrepreneurship, unity, and elevating the presence in the Asian American community. So, with this topic of preparing to raise capital in 2021's financial marketplace, I'd like to thank all the collaborators and our speakers and Mr. Wong for really, really extending your assistance to sharing your ideas in this community. At the same time, we look forward to more collaborations. We have started collaboration and just wanted to let you know the Filipino American members, as you don't know, there's over 150 member businesses now that are active, but people don't know there's about 120,000 Filipino Americans in the Metro DC area that remain silent, people you know about, but they don't really participate. So this time they are, and I'm so honored and grateful for our future collaborations. Thank you so much.
yeah, thank you, Christina. Amazing growth, your chamber under your leadership.
Thank you. Thank you.
Okay, so we just have to give a huge shout out to our wonderful sponsor, Zhongwei Tao, the president of the VIRS, and uh, Zhongwei currently also serves as the board of directors of the Asian American Chamber. He's a wonderful supporter of the chamber and very generously offer, his time and expertise and the generous sponsorship dollars to make sure, right, we are able to continue our program. So Zhongwei, would you be able to share, some sponsor remarks?
Sure. Thank you, Cindy. First of all, I want to really want to recognize Laura, our board member. I think is she brought this idea to the board team meeting one time, and we were talking about our how to really enrich our program as the Chamber of Commerce. And a lot of our members are small to medium-sized companies. They need a fund, capital to continue grow their business. And so Laura really brought this idea. We all talk about all the other members say, hey, can we sponsor this event? It's so meaningful. Tim is very gracious to, help us. So I say like, sure, this sounds a great opportunity because our company, whereas is also a small business in this region. We are a government consulting company, but research and development is also a key area, in our company's business. We're focusing on data analytics, modeling simulations. Innovations is also what we're passionate about. And for innovation to grow, we're looking for, capitals to help us. One of the areas that we did for this region is we create the dynamic pricing, algorithm for I-66. You probably remember there was a big news 2 years ago, in this region is people start to pay toll indifferent from what they used to pay.
Yeah.
It's more based on the demand. So it's a very new concept, a very new way for, improve, commuting, based on the demand, based on how soon you need to get to the destination. So a lot of new ideas, new innovation, in the transportation, in the mobility, how to enhance the mobility. These days you have a lot of new technology, new tools like Uber, sharing mobility. So we are very passionate in this region. So when the board member and Laura and Stephanie, we talk about this idea, I say, hey, great, this is something we are passionate about, and this is something we like to, sponsor to help, build this, help the community connect with, investor like a team. So that's why we're very passionate. We thank you for the opportunity, to give us, this sponsorship on this. So I know our time is limited today. So I'd like to turn to the, really the key, session, contents of this webinar. Cindy, if it's okay with you. So I'd like to introduce, our speaker first is Tian Wang. I have like a 2 full-page bio about Tian, but I don't want really spend time on that. I like Tian to speak, but I will just briefly highlight, Tian's, the bio. So Tian is a tech entrepreneur, CEO, and angel investor. He's the chairman and the CEO of Ops Inc., a private investment and strategic advisory company. Tian has made a direct investment in over 25 early stage companies and the VC funds. And as a recognized international expert in CRM, direct marketing, and the BPO, Tian has presented at dozens of conferences around the world. He has also provided industrial commentary on the ABC, Fox, NBC, CNBC. So I think I'll turn this to Tian right now. So this is going to be a very interactive sessions. So if you have any questions, please use the chat room in the Zoom meeting. And then after Tim finish his introduction, and then we'll just go through the questions and seek Tian's advice on those topics. So Tian, it's all yours.
Yeah, thank you so much. I really appreciate it, Zhongwei, and thank you so much to Cindy and Stephanie, Laura, and Terry, of course, and Christina, and the rest of the Asian American Chamber group. I'm going to share my screen. Like Zhongwei said, we can make this interactive. I don't have a whole lot of content. I guess I do have content, but can you guys see the screen yet or no?
Not yet.
No.
You cannot. Oh, sorry. Let me just try again. Yeah, is that? No. That's the whiteboard.
Yeah, so for some of you who
There we go.
Yes.
Now you can probably see it. So let's make it interactive. I know there's a lot of people on the call, including Terry, who have raised a lot of money in the past, who are also investing. And, I would love to answer any questions that you guys might have. I know if you want, I told the committee, if they really want to learn how to raise money, they can go on YouTube and watch Mark Andreessen or Mark Cuban or all these other real experts on how to raise capital. And it would be a heck of a lot more productive for them. But I do have a couple of slides I wanted to talk about. So concerning raising capital, and I have an appendix with a number of slides on types of capital sources, and I'm happy to discuss in more depth later. And obviously my contact information is there if you want to have a deeper conversation. I'm happy to do that. And also you guys can feel free to make these slides available to your membership if they'd like. So let me advance. Just a brief on my company. We help companies raise money. We help private equity and venture capital funds raise money. And we also invest directly. Right now we're focused on fintech, which is financial technology, health technology, and marketing technology, which includes customer relationship management technology. And that's my background is in the CRM and BPO call center space, so tech-enabled services. We also host the Connectpreneur community. Our next event is March 31. We have around 500 people at each event. These are monthly events online now. They used to be in person back in the day, and hopefully they will be back, next year we'll be back in person as well. And Connectpreneur, we've been doing that for 10 years. We're in our 10th year now, and it is a program that's, I think, has really benefited the community. It's benefited the Mid-Atlantic region and even the East Coast, technology companies, angel investors, venture capitalists, et cetera. So we're very, very happy about what we've done with Connectpreneur. And while COVID has really killed us in terms of revenue and our inability to sell sponsorships and ticket sales, what I see beneficial is that we can now go global. We have presenters from all over the world, including China and Australia, New Zealand, Scandinavia, all over. And we have investors from all over the world as well. So not just in the East Coast, but also West Coast and internationally. So feel free, it's a free event, so feel free to join us, and I hope you will do that. I think I just have a bunch of bullets here. I was thinking, what does it take to raise money? I've raised quite a bit of money in my career. I've raised all kinds of money, debt, I've raised sub-debt, I've raised mezzanine, obviously equity. I've sold companies and I've raised private equity to acquire companies. So as I was thinking, what would I do if I knew what I know today, if I knew 20 years ago? I think the first thing I would start with is you have to know yourself. And by knowing yourself, it means know what you're strong at, know what you're weak at, know your business better than any investor could know you. And you also want to know the story and have the vision and be able to communicate it well. I think most importantly is, why are you raising money? Do you really need it? Do you have a good use for it? If you don't need it, you can bootstrap, or you can use, we bootstrapped our business. We use customer deposits as working capital when we started our company. And I know that's crazy creative, but it can be done without equity. And also the ramifications of when you're raising the money, you have to know yourself. You have to be situationally aware and self-aware, because when you're taking on investor capital, now you have a whole set of fiduciary responsibilities that you didn't have when it was your business. So are you ready to not be a lifestyle business and be more of an institutionally capitalized business? And if so, you definitely would have to be ready for everything that goes with it. Midnight phone calls from your investor, crazy reporting and jumping through hoops for your investors. You have a whole new set of customers. So not only do you have to serve your customers and you have to serve your employees, now as the CEO or CFO, you have to serve your investors. So you have to make sure that you have the right temperament for that. The second bullet is, which structure is best for you? Raising money, it's like going to the Cheesecake Factory. There's so many different things you can eat at the Cheesecake Factory. There's so many different types of capital available. There's everything from equity to debt and everything in between. And we can talk about that in more detail, but my point is that each of these structures is financed by an institution or a lender or an individual who has a different source of capital. To my third bullet, right? Different source of capital, and they have their own set of constituencies and customers. If it's a wealthy individual, they answer to themselves and their family. If it's an angel investment group, they answer to their other angel investment partners. If it's a venture capital fund, they answer to their institutional limited partners. If it's a private equity fund as well, institutional limited partners, which are basically pension funds and retirement systems and insurance companies and wealthy families for the most part. So what I wish I knew when I started raising money was the motivations of the investors. So investors have different motivations depending on the type of investor. For example, time horizon. Some investors want to get in and out within X number of years, 5 years, 10 years, 7 years. That could be different from your goals for the company. So you may want to build something for 50 years or 20 years. And so getting an investor who wants to invest today, but get out in 5 or 7 years, you have to have a plan to take them out, whether it's a recapitalization down the road or, some kind of a replacement of an investor for a current investor, and if you want to own your business, you don't want selling the company to be how you pay your investor off. And also, so time horizon is very important, I think, when you consider, and also motivations of the investor. So I would study the investor's portfolio. Who have they invested in, and what types of companies and what types of CEOs, and check your references and try to understand the experience that the CEO has gone through in getting the money. In other words, how was the investor when everyone's great when times are good, but finding a good investor is like finding a good spouse, or a good significant other. It's a very, very, you should make it a painstaking process, because you will be married to this investor, for better or for worse, for quite some time, right? Whether it's 3 years or 15 years. So you want to make sure that you are aligned with respect to values and objectives. And what I do when I check references is I call the CEO and say, in good times, everybody's happy, but in bad times, how was your investor? What happened when you lost your biggest customer? What happened when, your COO quit? What happened when your CFO was caught doing some bad things, and how did the investor react? That'll tell you a lot about the investor. But really, the biggest advantage in doing this is, in doing the homework on the investor, is you will now help yourself when it comes to negotiating, because you'll know what levers to pull and what's really important to the investors and what's not so important. Number 4, preparation, critical. It basically, when you're raising money, you are trying to create certainty in your investor's mind, and you want to decrease their perception of risk. How do you do that? By showing that you got your act together, that you understand your business from A to Z, that you have command of your financials, your business model, your sales funnels. Everything from your cost of acquisition to your lifetime value of customer to what your renewal rates are and churn rates, et cetera. So having a command of that, as an investor, for sure, and a lot of people I know who are investors, that is a big thing, because they don't have a whole lot to underwrite. They can underwrite your customer contracts, they can underwrite maybe, how secure is your intellectual property protection, things like that. But really, you as the CEO or as a C-suite member, when you're raising money, the buck stops with you. And if you show that you're prepared and you are on top of it, that builds a lot of confidence in the mind of your investor. So having a data room that works, that's organized, having answers right away. If someone wants to see a cap table or waterfall analysis or whatever, you have it right there and you can provide it immediately. You don't have to go back and figure it all out and take 2 days to do that. So preparation, it's like anything else in life. If you're, prepared, good things could happen, and you mitigate the bad stuff. Also, it'll help you when you negotiate, because not all investors, Terry will tell you this as an investor, and myself, we see a lot of deals and not everybody's got their act together. So yes, I might invest, but I'd be more comfortable investing in a team or an individual or a founder who is buttoned up completely. It's a sign of professionalism as well, and investors want to invest in professionals. The next bullet is developing a sales strategy. Yes, sales. I intentionally use the word sales because raising money is selling, and basically, it's selling, meaning you have to do the proper discovery, identify your suspects, do your homework, make the phone calls, make the second call, make the third call, make the fourth call, have the first meeting, have the second meeting, and just be persistent and grind away. So raising money is not, I'll send you a deck and an executive summary, and I'm hosting a event next week, and you're going to join 20 other potential investors. It doesn't work like that. I think you have to have a sales strategy, much like you go out and sell customers. The next bullet is about advisors. They are expensive. The best ones are, but you also get a great ROI. And the one thing that I'm so happy that, and I've done many rounds of financing for my own companies, probably a dozen or more even, as well as all the financing when we make investments, is having great lawyers. They're so expensive and they're so difficult, but they keep you out of trouble and they help mitigate your risk as an investor. And as a recipient of capital or user of capital, also having good lawyers is critically important. Why? Because, and accountants as well. Why? Because they're in the market every day. They know the terms of the deal. They know what is winnable and what's not winnable on a negotiation item. Having investment bankers is the same thing. These guys do this for a living. We as CEOs do not raise money for a living. We build businesses for a living. These bankers are doing several deals a month, so they know what's happening. So if they're good, they should give you a 10x return on what you're paying them. And this goes for anything. If you're buying a company, if you're financing a company, or if you're selling a company, having great advisors, because they're experts, true experts in their field, they will help you be successful. And then the last thing is mindset. You know, we all see Shark Tank, we all watch Silicon Valley on HBO, and we all see all these great shows, and we think raising money is this glamorous thing, and it's, you know, it's a rite de passage, you know, for entrepreneurs. Oh, I got an institutional VC round done. Not at all. It's a grind. It's very difficult. It's depressing at times. It's like a roller coaster. You have good days, you have bad days. It's also a full-time job. Your full-time job should be getting customers and building a great team and building a great product. But when you're raising money, you're spending all your time with investors and investor prospects, and you know, getting information. So you really have two jobs when you're a CXO and you're raising money. You know, you have two jobs. Job one is your day job, which is building a business, and job two is raising your money. So there aren't enough hours in a day. So I think having the mindset that you're in for a long haul, very difficult process, and it's going to require a lot of mental resilience and persistence will help you. So those are really the key points that I have for raising capital. I am happy to open up for questions. I do want to tell you guys that there is more to the presentation. I can maybe preview some stuff here. So this would be sort of some types of investors. If you look at the capital stack, you know, from the basic FF and F, and FF and F stands for friends, family, and fools. You know, before FF and F, you have credit card debt and second mortgages and third mortgages. But then you have FF and F, and then you have angels, seed investors, and then you get more institutional as you go down the stack. So you have Series A institutional venture capital, growth equity, which would be more Series B and C, which is your second and third, fourth rounds, pre-IPO rounds. Debt, which is basically consists of senior debt, which we're not really going to talk about because that's sort of stuff that Stephanie can talk about. You know, that's senior debt. And I also know that M&T does do mezzanine financing. Hugh Giorgio is a friend and an investor of mine, and he's over at M&T and their capital markets deals. So they do mezzanine deals where they will want a higher internal rate of return. And then private equity, which is sort of your buyouts, control positions or minority positions on larger types of companies. I'm happy to show you the rest of the slides, and then we can take questions. Here's our appendix. So these are sort of some examples of venture investors. So you have these are some names of companies you may know, you may recognize. Some of them are local, some of them are national, but you have corporate venture funds. So yes, corporations can invest in your company. The state of Maryland has TEDCO, the state of Virginia has CIT. These are monies that come from the state coffers, and they deploy them as equity investors, usually as co-investors along with some of these other types of groups. Angel investors, I know Terry's a founder of the MIT Alumni Angel, so that would be another example of an angel group. Family offices, so wealthy individuals, incubators and accelerators, individuals. These are some thoughts on friends, family, and fools, the kinds of amounts that they play in, the valuations, the structures are more loose and informal. And then as we go up the stack, there's more complexity, more formality, more professionalism, more reporting requirements, more governance, and things like that. And we have here seed investors in Series A. This is now you're in almost the institutional, what I call institutional type of investor, where they have institutional limited partners, which are sort of those retirement funds and pension funds and insurance companies that I mentioned. These guys are investing mostly out of defined fixed term limited partnership funds. So they might have a fund for 10 years. And in the first few years of the fund, they'll sort of deploy their capital. And they want to close out the fund within 10 years. So when I talked earlier about a short-term horizon, if you get an investment from a fund that's in their third year, that means they want to get out in 7 years max. So you have to keep these kinds of things in mind. And here's sort of your little bit on growth investors, a little bit on debt, equity. I can talk about any and all of this stuff at your convenience, but let me stop there and just
All
open
right.
it up for comments and questions.
Thank you, Tim. We got a number of questions already in the chat room. I'll just starting from the beginning. The first question we have is, if the company really needs money, but the VC willing to invest to you may not be an ideal one, do you take the money or just keep on searching?
No way. I would never take the money because, like I said, it's like getting into a bad marriage. Like no one wants to get into a bad marriage. Because the other thing about VCs is to me, they are the investor of last resort, which means, I mean, just look at the numbers, right? Everyone thinks they have a fantastic company and they're going to make, a huge success. But the reality is, if you look at a VC's portfolio, look at a pre-A round or an A round VC and ask them, out of the 50 investments you've made in the last from 3 years to 10 years ago, how many of those CEOs did you fire within 3 years? And the answers were around 50%. So if you take money from a VC, basically, statistically, you have around a 50% chance of getting fired within 5 years, maybe even 3 years. And it depends on the fund. That's a question that is seldom asked and it's never talked about. But that's why I call them the investors of last resort.
Right.
So if you have a VC you don't like, do not go near them. I'm an LP in a bunch of venture funds. So I've invested and what I do is I call, so when a venture capital fund is trying to raise money, they might send me the package and I might write a check, I might not. I've invested in several. I call the CEOs of the portfolio company. I said, how are these guys to deal with? Are they coachable? Are they arrogant? Are they good guys? Are they adding value on your board? And oftentimes I get the answer that they're terrible to deal with. So I don't invest as an LP. So there are a lot of VCs out there that have bad reputations and deservedly so. So no, I would never take money from an investor who I didn't get along with.
Okay.
Treat it like a marriage.
Absolutely. As you said, Ken. Move on to the next question is, I think this probably refers to one of your slides when you talk about you need a group of advisors. So the question is, can you recommend some lawyers or have a list of, you can recommend?
Oh, absolutely. It depends on the industry. When I pick an advisor, I like to pick advisors that know my space very well. For example, when I went to sell my company, I hired an investment banking firm out of Boston, but they were headquartered in Atlanta. But why did I hire this firm? Because they knew my industry really, really well. They knew all the buyers, they knew all the deals that were happening, they had all the comps. And it's the same way with lawyers and accountants. Less so with accountants, but if you're in a software business, you want to use an accountant that knows software. If you're in tech-enabled services or government contracting, let's say, you want to use a law firm that really understands government contracting. So I think, yeah, there are many, and I'm happy to talk offline about specific names. It's also geography and also chemistry with the partner, I think. So, like when I hired Ernst & Young, I hired them for brand, and I also made sure I got a partner that I got along with. So I think that it's also not just the firm, but the person you're dealing with.
Okay.
So, yeah.
Yeah, Tim, everybody see like on the screen that's Tim's contact information. So you can follow up on that. The next question is a bunch of small questions all connect together. Is the first one is what percentage of your meeting lead to term sheet? How often should we expect to meet after funding? Should you look for investor that have made follow-up investment previously? Can you discuss a little bit about the due diligence process?
Yeah, that's a lot, I guess. So is the question more around the process from when you meet an investor to when you close the funding round?
Well, I'll go with one small question, one by one. So what percentage of your meeting lead to term sheet?
As an entrepreneur, I think a term sheet from an angel group, an angel investor, or a VC. Because I think, with VCs, well, it depends. It really depends. It depends on the company. I was on the advisory board of a company that we all probably know, but I won't name them. But they were doing their rounds of capital. They were getting like 15 term sheets from VCs. They were a hot company, and they had a great team, great CEO, good traction, good growth. So they got the VCs really interested. The thing about venture capitalists is they tend to make decisions. They like social proof. They really like social proof. So if you can get a big name VC in as a lead investor, you'll get a bunch of other VCs that'll join in.
Okay, I think the question probably is centered around after the first initial meeting until the end. When you get the term sheets for for the investment is is finalized. How long this process is, how many meetings you expect to have.
I think that's a function of a few things. It's a function of how hot you are. It's a function of how desperate the VC is to invest in you. Because the more they love you, the quicker they can move. In California, I've heard of term sheets being issued within like 24 hours.
Wow.
But I've never heard of that in DC. But in DC, I know some investors that have issued term sheets within a week. But sometimes, they like to monitor you. So they won't invest. They'll monitor you for a year or 6 months or 2 years, and then they'll come in later in a subsequent round. So it really depends. And my metaphor for you would be like it's sales. So how long from first meeting to closing a sale? It depends. Depends on the buyer. Depends on the buyer's motivations. It depends on how your product fits their needs. It depends. So with a VC, it's the same thinking. Does your company and your product fit the markets and the investment themes and strategies that they themselves are looking to invest in?
Okay.
Yeah.
Great. Thank you. So the next question is for the CRM or SaaS business, should one approach specific funds that might have portfolio in the SaaS space or approach general funds?
No, I would go to funds with expertise. Why? Because the last thing you want is a board member or an investor who doesn't understand your business, because then they're going to waste your time with inane questions that are wasting your time, and you're going to be frustrated. You want someone who understands your business so they can add value. They can make introductions, and not all SaaS companies compete with each other. So, if an investor has a portfolio company that's a competitor of yours, they probably will not invest in you. Sometimes they do. If they're big funds with a lot of capital, yes, they will do that because they like to spread their money around. But oftentimes they'll say, you know what, we're already in this other company, they're a competitor. But generally speaking, yes, if you have a cybersecurity company, I would go to a cyber-focused fund. If you have a medical products, medical device, I would go to a medical device-focused fund for the reason that you want to have aligned values. And if these guys understand your markets, your business, your competitors, and the dynamics of your space, it's so much better. So in a perfect world, I would definitely go to a specialist.
Okay, great. The next question is private equity financing more complicated than the commercial banking financing?
Oh yeah,
some investors a lot. Okay,
a lot more. I mean, commercial banks. This is a question for obviously Stephanie or Laura, but they underwrite your creditworthiness, your financial statement, your personal financial statement, your company's financial strengths, your durability of revenue stream and your balance sheet and things like that. Whereas a private equity fund is looking at that and more, basically. So it's a lot more complicated.
Okay, yeah. I think the comment is, some investor will ask for the ownership in the company, but the control of it. But I think is the commercial bank will not need that.
No.
To do.
Commercial banks usually provide debt, and there's no equity.
I see. Okay. The next question is, can you discuss acquisition multiples for bootstrap business versus VC-backed business? Does that depend on ARR in the space?
Yes, I mean, multiples in general for valuations in funding and in sales are a function of a couple of things, right? They're a function of your growth rate, and it's a function of some what I call, some substance, right? So you have to have some scale, some mass already. In other words, a company that's doing 100 million in revenue will get a higher value than a comparable company doing 10 million. The 10 million company will get a higher value than a company doing 3 million, just because of size and scale. The growth rate's critically important. If you have a SaaS business, say, basically, you want to have a SaaS. So I'll just give you an example. Like a software as a service company, from what I see sitting on board at CIT for 14 years, we see a lot of deals, and I would say that those companies, depending on the market, they trade between 5 and 10 times revenue, annual recurring revenue. That's what ARR stands for. But that assumes a growth rate, and the growth rates, have to be impressive, whatever impressive means, right? But 10% a year is no good. It's got to be maybe 150 to 200% a year. These guys are looking at growth month over month sometimes, the investors. So if you're showing huge adoption and revenue traction, then you can command that 10x multiple. But if you're flat, or you're growing at 30% a year, 40% a year, that's not so impressive to a technology investor.
I see. All right.
So the answer is, it depends. What's your house worth? Well, it depends on a lot of things, right?
Sure.
Yeah.
Tim, the next question is, can you please tell more about valuation of startup, biotech companies? The valuation of startup biotech companies.
Yeah, so I'm not a biotech investor or expert by any means. I mean, I think that the difference about biotech companies for the most part is they have long product cycles, and they're hugely capital intensive. It's not like you can spend $500,000 and have a software product up and start marketing it, for SaaS customers. It's a totally different thing. These guys are doing inventions, and then they have to get them tested. They have to go through regulatory approvals and several rounds of FDA approval. So that's when I say, so the biotech investment firms understand that dynamic, and they're willing to make a bet, but they also know that a lot of their bets are going to fail. But that's their business model. They expect that they're going to have a few $1 billion, $5 billion exits to do that. So, that's a great question, and I'm sure that's situational, but I would have to defer that to, some real expert biotech investors.
All right. Thank you, Tim. One more question here is it better to give advisory shares for a bootstrap company that does not require funding, but trying to bring expertise for decision making? Or should the company try to raise a small round for the LP expertise?
No, I think, okay, let me just back up. That's a great question. Doesn't matter. My answer is the same, whether it's a bootstrap company or an existing company. Your job as a CEO is to build a business. Capital is just a tool to build a business. It might help you build faster. It might help you build better. It might help you staff up faster. But capital is just a tool, right, to build a business. And advisory board advice, to me, is true intellectual asset, much more valuable than money. So yes, I would give shares up for excellent advisors. Why? Because the advisors can help you avoid pitfalls, because they theoretically have been where you are, and they can see ahead where you can't see as well. They have contacts. They can bring customers, maybe. They have investor contacts. Maybe they can bring some investors. They can bring other industry experts to the table, channel partners. I mean, the things they can do for you are unlimited. So I'm a big fan of leveraging experts, board members and advisory board members, and paying them for it. You don't have a lot of cash as a bootstrap company. Bigger companies can pay cash, but I would definitely give them stock, as a lot of these guys aren't doing it for the money. They're doing it because they like you, or they like the industry, or they want to stay engaged and involved. But I think it's a very nice gesture to give them compensation. It's expected, and it's a market term for advisors. But raising money to me is a separate matter. So, and by the way, having great advisors and board members will help you raise money because it adds credibility. Remember I said earlier how investors want to lower their perception of risk and they want more certainty. Well, when an investor sees that you've got all these luminaries helping you, that gives them more confidence.
Okay. The other question I have is more maybe from my experience, Tian, is, in the Northern Virginia and the Washington, D.C. sector, in the region here, in a lot of business, technology company are around serving the government. So they are not necessarily the technology product company. They are more sort of embedded, technology innovation in the service offering to the government. And we start to see really a trend like a private equity company really start to invest money into this company. One of the example I know is, the well-known, venture capital, Peter Thiel, from Silicon Valley, they found a company, the data management company called Palantir. It's a data management technology, and they really won a lot of contracts from Pentagon and DoD. So how do you see that trend, happening, grow? What the company like a government contract service company should position themselves, or should they welcome those trends, or should they, what's the strategy for them to do at this time?
Yeah, so in terms of your traditional tech investors, they're not interested in a services business like a GovCon. I think Palantir is its own animal because I think when they started, they did not start as a services business. They purport to have a product, then they also purport to sell it into the intelligence community. So it's very black box in a black box. So, I'm not privy to any of that information, but I think they were very good at packaging it. And, Peter Thiel and his buddies kind of led that round, the initial round. So they sort of had an insider's advantage, I think. But for your run-of-the-mill GovCons, I think if you have a product that's really working for the federal government and you think that there's some commercial adoption and it's a true product, right? It's either a device or it's a software product of some kind, then absolutely you can go out and raise capital to spin off that company and incubate it and grow that business as a separate entity. I think in terms of attracting investors into a government contractor itself, generally, this is really general, government contractors don't have a lot of working capital. They have working capital requirements that they don't have a lot of, they're not capital intensive in the sense that they need to build products and stuff. So a lot of it can be financed with debt. There's a lot of debt providers for government contractors. And then maybe you'll see a number of private equity firms like Arlington Capital, which is a local firm here, which most of you know. They buy control positions in government contractors. They understand the space really well. They understand the nature of the contracts. They know the people at the agencies. Carlyle Group has also gotten involved in some aerospace and defense investments. But those are more for larger companies that are established and they're proven and they've been around for a while. So, and I don't think they're investing in those companies for growth. They're investing in those companies because they have a reliable source of cash flow, and it's usually part of a roll-up or some kind of an aggregation or some kind of financial engineering play. So, but to answer your question, if you're a GovCon and you have some great products and some great technology that you've developed that is commercializable, proven to be at least, in a piloted way or whatever, not just some idea on a blackboard or a whiteboard, then I think you can go and get equity capital for that.
Thank you. I think we have a few more minutes left. Tian, another question we have is also, the pandemic started last year. It's really affected how people communicate with each other. Used to have this face-to-face meeting. You can meet the venture capital, give them the ideas. But now it's become all virtual. From your experience, how do you see that trend continues? Like you mentioned that your company have a couple of events, like every month. Can you give us more detail about those events? Can people join those events virtually, or has this had to be face-to-face meetings?
Well, I think the pandemic has necessitated virtual meetings and virtual activities. I think someone told me the other day, I heard it was a great comment. It's like virtual resulted because the alternative was zero, was nothing. In the context of investors, why are investors investing with virtual? Because if they don't invest through virtual means, then they won't be able to invest, and they only make money when they invest money. So they have no choice. Same thing with Connectpreneur. We had no choice. We had to go virtual, or we could just stop. I know a lot of colleagues and friends in the event space that stopped doing events because they just didn't see value in doing virtual events. And we took a different approach. We were like, well, we have no choice. We have a great community. Let's just do virtual events. So it's not as good as in person, never is, but there are some benefits. You're able to get people from out of town to tune in. You're able to attract community members from around the world, and they're free events, so you can offer this to other constituencies like universities or students or government employees. So there are some benefits. I think it'll be interesting to see what happens once people have the confidence to get together and do meetings again. I don't know what's going to happen. My sense is that within 2 or 3 years, people will probably want to meet in person to make investments. They're going to want to go visit facilities and go meet development teams.
Mhm.
Our events, for us, we're going to keep doing virtual events going forward. There's no reason not to. We have constituencies from around the world that are counting on us now. So we're going to continue doing events around the world, virtual events every month. And then when we go back to doing these live events, and I have no idea when people are going to want to go to a 400 person, 500 person event in the future, it has to be an incredible event for sure, for someone to leave their house and also to, to deal with that kind of thing. But it might take another 2 or 3 years. Maybe we'll see smaller events. I mean, we don't do smaller events per se, but I think we're just flexible, and we want to stay tuned into our customers and just try to provide an awesome experience.
Sure. Can people go to your website to find the logistic details about your events?
Oh, absolutely. Connectpreneur.org. I want to shout out Skylar, who's on the call. Skylar is our community manager for Connectpreneur, and Jet Liu, who's one of our co-hosts for Connectpreneur. And those are some great teammates of ours. But yeah, go to connectpreneur.org and you'll see all the information on our events, the registration link to Eventbrite. We have all the program books from all of our previous events. We publish the names of all the attendees in every program book, and we've done 57 events over the last 10 years. So
Okay.
Yeah, so thank you for letting me plug that.
Great, no problem. One more last question, we know we are really up to the end, is as a government contract, back to that government contract topic, is there any thoughts or insights on raising capital for acquisition towards the end?
Yes, that's where I would bring in private equity. So I do have a couple of friends who are in the GovCon space, several, who do exactly that. They will raise money from private equity firms to go buy go buy other government contractors. So that is a thing. They obviously, they try to use debt, senior debt, and they will raise equity. And the equity comes from funds that specialize in government contracting businesses.
Okay.
Yeah.
Cindy has a question at the end. Thank you so much, Tim, for sharing your wealth of knowledge. Can we share your slides if Chamber gets the request?
Oh yeah, of course. You can share my slides, and yeah, no issues at all.
Great, thank you, Tim. Really so much appreciate your time. I turn the webinar back to Cindy.
Okay.
Thanks for having me.
So Tien, yeah, so wonderful having you today. And I think everyone here is super lucky to, listen directly to you. And actually, many of you, if you don't know, actually, Tien was the Asian Business Leader awardee at one of our previous Jules Fisher Gala some years ago. And you know, I think it's wonderful, like he can, you know, share his wealth of knowledge with everyone today. And Ting, Ken Fong, he is our chair for the GovCon committee. Maybe in the future, when they plan future events, they can invite you back for one of their future event series.
Yeah, absolutely. My pleasure, Ken. Yep, just let me know.
Yeah, thanks so much for your time.
Okay. So another shout out to Zhongwei for wonderful moderating the event and also sponsoring the event, and our co-host today, Terry, Christina, and wonderful to collaborate. And hopefully we can collaborate in the future again. And thanks all for joining this event today, and have a super nice day. Thank you.